Imagine, just for a second, a solitary math geek. A guy sitting thousands of miles away from all the Wall Street risk managers, just staring at a bank of computer screens. Over the course of just a few months, this single individual is going to construct an absolutely unfathomable, historic bet on the weather. He's going to leverage billions in other people's money, fully believing he can outsmart Mother Nature herself and literally outmuscle the entire global commodities market. What follows is a complete masterclass in hubris, flawed financial engineering, and the absolute limits of market manipulation. It's a story that brought a towering financial empire to its knees in a matter of days. Now, I'm not going to reveal the final staggering dollar amount just yet, but by the end of this explainer, you're going to look at the gas heating your home in a completely different light.
Okay, let's dive right into this. To really understand how we get to the disaster, we actually have to start with the golden year. Picture this, it's the end of 2005. A single natural gas trader takes home a personal performance bonus of roughly $100 million. Seriously, let that sink in for a second. One trader, one single year, $100 million. He is living large. He's filling his garage with a Ferrari F430 Spider, a Bentley Arnage, the whole shebang. To the outside world, he basically looks like a total market wizard who completely cracked the code of energy trading. But beneath the shiny veneer, all those luxury cars, the foundation of his strategy is completely clueless to the massive, systemic risks he's actually taking.
So, the man behind the wheel of that Bentley is Brian Hunter. Growing up near Calgary, Alberta, he definitely wasn't your typical slick Wall Street banker. He was a bona fide math geek with a master's degree from the University of Alberta. He cut his teeth over at TransCanada before taking the leap to Deutsche Bank in New York, and initially, his algorithmic approach seemed like pure magic. He made something like $69 million in just his first 2 years. But then, we get a massive warning sign. In December 2003, his trading group lost $51 million in a single week. Hunter, of course, blamed an unforeseeable run-up in gas prices and actually blamed the bank's own trading software for letting him take such massive gambles in the first place. He even sued them for his bonus. And, well, unsurprisingly, Deutsche Bank fired him.
But, you know, on Wall Street, a $51 million loss is sometimes just seen as the cost of an aggressive education. So in 2004, Hunter gets scooped up by a multi-strategy hedge fund called Amaranth Advisors, and he quickly becomes their absolute star. Fast forward to 2005, and SAC Capital actually tried to poach him with a $1 million signing bonus. So, to keep him, Amaranth's CEO, Nicholas Melomonis, basically handed over the keys to the kingdom. He made Hunter co-head of the energy desk, gave him complete control of his own trades, and let him set up a remote office way back in Calgary, which is very far away from Amaranth's compliance officers in Connecticut. But most importantly, they gave him an eat-what-you-kill deal. Hunter would get to keep a massive 15% cut of all the profits he generated.
And man, that 15% cut paid off spectacularly. That's what led to that $100 million bonus we talked about. So why so much? Well, in 2005, Hunter bet aggressively that natural gas prices were going to spike. And then tragedy struck the Gulf Coast. Hurricanes Katrina and Rita devastated the physical natural gas infrastructure down there, which heavily disrupted supply. Because of that, prices absolutely skyrocketed. So Hunter's super aggressive risk-taking suddenly looked like pure genius. He generated roughly $1 billion in pure profit for Amaranth. That was almost the fund's entire return for that whole year. He was the golden boy. And because he just made them $1 billion, management essentially left him completely alone in Calgary to do whatever he wanted.
So, going into 2006, Hunter deployed a specific, highly leveraged financial strategy called a calendar spread. Here's how it generally works. Natural gas has a very specific seasonality to it. On one hand, people use a lot of it in the winter to heat their homes, so winter contracts historically command higher prices. On the other hand, in the summer and fall, demand is much lower, so prices naturally drop. Hunter bet massively on this historical relationship holding true. He went heavily long on winter delivery contracts, meaning he's betting the price would go up, and simultaneously shorted the near-term summer and fall contracts, betting those would stay low or drop. Basically, he was betting that the spread between cheap summer gas and expensive winter gas would widen even further.
But here's the thing. Hunter wasn't just sitting back and relying on the weather to widen the spread. He started using a highly aggressive, deeply controversial strategy that really pushed the limits of the law. It's a market mechanic known as banging the close. Now, in normal trading, a fund is going to spread their trades organically throughout the day, right? They do that specifically to avoid disrupting the market price. But Hunter did the exact opposite. He would hold massive amounts of natural gas futures right up until the very end of the trading day, specifically those last 8 to 30 minutes before the market closed. And then, He'd just flood the market with aggressive sell orders. By dumping massive volume all at once when liquidity was super low, he artificially crashed the settlement price.
And look, this isn't just theory. We actually have the instant messages from Amaranth's internal systems to prove it. On February 24, 2006, right before executing this exact move on the March contracts, Hunter messaged a colleague. He literally typed, "We have 4,000 to sell mock," that means market on close, and then wrote, "Shh, bit of an experiment mainly." His colleague replied with something along the lines of, "Unless you are huge bearish, why the F would you do that?" Rightly pointing out that selling so much all at once was totally crazy unless you actually wanted to crash the price, which of course is exactly what Hunter wanted. It really highlights the shocking casualness of high finance, doesn't it? Crashing a globally benchmarked commodity was literally just a bit of an experiment to him.
Now, what's really interesting here is how clearly the data from April 2006 illustrates this exact market manipulation. If you look at the financials, Amaranth held massive short positions on financially settled swaps, making millions for every single penny the market dropped. At the same time, they held physical futures contracts on the NYMEX exchange. What they do is carefully build up a long position in those physical futures right up until settlement day. Then, suddenly, they'd completely dump all those NYMEX futures in the final minutes of trading. Doing that artificially crashed the benchmark price, which instantly made those massive short swap positions immensely profitable. It wasn't an accident. It was completely calculated and perfectly synchronized.
But to actually pull this off, Hunter had to build positions of an absolutely absurd scale. He wasn't just trading in the natural gas market anymore. Brian Hunter essentially became the natural gas market. By early to mid-2006, Amaranth controlled an astonishing 81% of the open interest in specific contract months. Just think about the sheer scale of that hubris for a second. We're talking about holding over 80,000 futures contracts. When you hold 81% of a market, you aren't just betting on the direction of the market anymore. Every single move you make is the direction. It creates this incredibly dangerous illusion of total control.
But here is the fatal flaw in that illusion. You absolutely cannot control the actual physical fundamentals of a commodity forever. In the spring of 2006, the weather simply refused to cooperate. Hunter was betting heavily on winter gas prices spiking due to high demand and potential hurricane disruptions, remember? But the forecasts actually started predicting a very mild winter. And because production had been running super high and demand was actually quite low, physical natural gas storage levels all across the country just filled up to the brim. They hit 7 to 11% above their 5-year historical averages. The real-world facts had completely shifted against his massive calendar spread.
So, as the actual price of natural gas began to steadily drop, Hunter's highly leveraged bets began to seriously bleed. By May of 2006, the spread he was betting on started to completely collapse, and out of nowhere, his trading book was suddenly down a staggering $1 billion. This was an absolute five-alarm crisis. Hunter had just blown past the fund's internal risk limits by 4 times. Management finally woke up from their total complacency, ordering the Calgary team to immediately fly out to Greenwich to be directly supervised. But honestly, the damage was already way too deeply embedded.
So, the crucial point here is that Hunter had essentially built a massive liquidity trap for himself. He was the ultimate elephant in the china shop. His positions were so impossibly large, again up to 81% of the market, that he physically could not sell his contracts to cut his losses. Think about it. If he even tried to sell, the rest of the market would immediately see him coming. Liquidity would just completely vanish, and his own selling would crash the price even further, destroying his portfolio instantly. He was totally trapped by his own massive size. So what exactly does a desperate trader do when he literally can't retreat? Well, he doubles down. Hunter actually bought more contracts at lower prices, praying the market would eventually turn back in his favor.
Spoiler alert, it didn't turn. It got much, much worse. Just track this collapse. After taking that initial billion-dollar loss in May, Hunter held on for dear life all through the summer. Then, in August, the NYMEX exchange raised their margin requirements. By early September, prices just kept falling, and those margin requirements crossed a suffocating $3 billion. They were literally running out of cash to keep the lights on. And then came Thursday, September 14th, as the spread completely, totally collapsed in a market that had exactly 0 buyers. Amaranth suffered its worst day in history. In a single trading session, they lost $560 million.
At this point, the blood was definitely in the water, and Wall Street's apex predators began to circle. Over a really frantic weekend, Amaranth desperately tried to sell off its dying portfolio to Goldman Sachs to save itself.
But JPMorgan, who was actually Amaranth's clearing broker and held their margin, flat out refused to release the necessary funds to make the Goldman deal happen. Instead, JPMorgan teamed up with the Chicago-based hedge fund Citadel. Leveraging their dominant position, they basically forced Amaranth to sell the natural gas assets for roughly 50 cents on the dollar. That was about $2.5 billion. It was an absolutely ruthless, predatory rescue. And within months, as the market naturally rebounded, JPMorgan and Citadel reportedly made about $1 billion each right off those distressed assets.
When the dust finally settled in late September 2006, Amaranth Advisors had realized a total, unbelievable loss of $6.6 billion. Let me just repeat that so it sinks in. $6.6 billion of investor wealth just vaporized in a matter of weeks by a single trading desk. At the time, it was the largest hedge fund collapse in world history. A firm that managed over $9 billion just a few months earlier was forced to completely dissolve, and it was entirely because they allowed one math geek in Calgary to leverage their entire existence on the autumn weather.
And this brilliantly illustrates the stark contrast between pure gambling and true investing. Just look at the two biggest players in the natural gas market that particular year. On one hand, you have Brian Hunter. He traded derivatives strictly based on historical volatility patterns, completely ignored the changing physical reality of those full storage tanks, aggressively pushed market limits, and ended up losing $6.6 billion. But on the other hand, you have his fierce rival, John Arnold, who was running the Centaurus Fund. Arnold actually understood natural gas as a physical commodity. He tracked the pipelines, the real storage capacity, the actual fundamental supply and demand. He saw Hunter's massive, foolishly leveraged positions, took the exact opposite of those trades, and walked away with a $1 billion profit that very same year. At the end of the day, physical fundamentals will almost always crush financial engineering.
So what actually happened to the guy who lost $6.6 billion? Honestly, the aftermath is surprisingly anticlimactic. The Commodity Futures Trading Commission and the Federal Energy Regulatory Commission both scrutinized Hunter's outsized market influence. FERC initially tried to hit him with a massive $30 million fine, but Hunter fought back in court over jurisdictional technicalities and actually won an appeal. He ultimately settled with the CFTC for a fine of just $750,000. I mean, that is a literal drop in the bucket compared to the $100 million bonus he took home just the year prior. Regulators did block him from launching his own new fund, sure, but he basically just quietly transitioned into a very lucrative consulting role.
Let's move on and see how this builds for the guys at the top. What about Nicholas Monis, the CEO who happily allowed all of this to happen right under his watch? Well, on Wall Street, a spectacular failure is often just a stepping stone. By 2008, Monis had already launched a brand new multi-strategy hedge fund called Verition Fund Management, naming it, ironically enough, after the Latin word for truth. He even hired back several of his old Amaranth executives. Despite having a spectacular $6.6 billion implosion on his resume, institutional memory on Wall Street is incredibly short. By April 2025, Verition had actually grown to manage over $12.6 billion in assets, boasting steady, positive returns by utilizing much stricter risk controls.
Which leaves us with a fundamental, deeply unsettling question about the actual mechanics of high finance. Remember, Amaranth gave Brian Hunter an arrangement where he personally pocketed 15% of the upside. That meant tens of millions of dollars directly into his bank account. But when his bets totally failed and $6.6 billion evaporated into thin air, he didn't have to pay back a single dime of those massive losses. It was the investors, the pension funds, and the firm itself that took the entire hit. Think about it. If a system is specifically designed where a single trader gets all the massive rewards of risk, but suffers absolutely none of the financial consequences of a structural failure, isn't spectacular destruction essentially guaranteed? It's a massive question of moral hazard, and it's one that continues to haunt the markets to this very day. Definitely keep that in mind the next time you hear about some star trader making $1 billion bet.